There are a lot of things we can potentially learn from the Silicon Valley Bank and the other bank runs and banking issues that we're seeing right now. One of those, apparently, is that if you want to bail out, then make sure you're able to cause
systemic risk and significant economic and financial consequences.
But in addition to all that, I think there's a very specific lesson we can learn from Silicon Valley Bank when we go ahead and take a look at their balance sheet and how things were accounted for, because there are some pretty eye-opening things going on, and they're not obvious at first glance. So here's Silicon Valley Bank's balance sheet as reported in their annual report that was issued on February 24th, 2023. Now this goes up to December 31st of 2022. So this would be their balance sheet as of the very end of 2022. So by the time this was officially reported, it was technically a couple months out of date, but that's the nature of financial reporting and accounting in the world of publicly traded stocks. Now the balance sheet for a company shows the breakdown between their assets and liabilities. The assets would be the things of value that they own, whereas liabilities would be things that they owe or otherwise have to pay to other parties. Total assets minus total liabilities gets you the company's equity. And if a company has more liabilities than assets, that means they are insolvent, in that if they needed to liquidate all of their assets, they still wouldn't have enough money to pay back all of their debts and liabilities. In Silicon Valley's case, they claim that they had about $16 billion in equity as of the end of December. Now let's take a look at a very specific item on the asset side of their balance sheet. It's these held to maturity securities up here towards the top of the balance sheet. These are listed as being worth $91 billion, which is almost half of their total assets. So it's a very significant item on the balance sheet. Now, as a bank, it's not surprising that they would own a bunch of securities. That is very common practice. Banks will buy lots of bonds in many cases just to try and get some yield on their cash in the meantime, since they are holding a ton of cash because that's what deposits are. So that's not exactly a problem in itself. But what exactly are these held to maturity securities? Well, we can find this breakdown deep in the annual report on page 66 to be exact. Maybe that is an ominous sign. But it looks like most of these securities are bonds, specifically mortgage-backed securities and then commercial mortgage-backed securities. That is the vast majority of what these held to maturity securities are. And of the 91 billion total that they have marked here, over 80 billion of that is mortgage-backed securities of some sort. But the kicker here is that the yield on these securities is 1.66%, which wouldn't necessarily be a problem except for the fact that these bonds are long-term bonds. Most of these bonds were 10 plus year terms. You can see this after 10 years column here. $86 billion of the $91 billion accounted were over that 10-year threshold. And that makes you subject to something called interest rate risk. When you buy a bond, you're buying an income stream, and that income stream doesn't change, even if the price of the underlying bond changes. And when we talk about bond pricing, we're talking about the yield on that bond. That is, how much income are you getting relative to the price of the bond. So if the yield on a bond goes up, it doesn't mean that the actual income stream is changing, but it means that the underlying price of the bond is going down, because you can now buy the same income stream for less money. And if you bought a bond at a 2% yield, and now there's a bunch of other bonds that are of similar quality that are now selling for 4% yields, no one's going to want your bond at a 2% yield, so you're going to have to drop your price to get it up to that 4% yield to make it attractive. At least if you want to sell the bond, because if you hold the bond, so long as the person making the bond payments actually makes them, then you will eventually get all of the money back that you paid to buy the bond at that applicable yield when you made the purchase. Now, I mentioned that the bond portfolio that Silicon Valley Bank had on its balance sheet would be subject to significant interest rate risk. And that's because they are long-term bonds. With a short-term bond, you can wait to get all of your payments back, and it shouldn't take too long to actually get there. Whereas with a longer-term bond, you have to wait a lot longer to get all of your payments back. So the interest rate risk is greater on a longer-term bond because of that. Now, in their annual report, Silicon Valley Bank says that their weighted average yield on their held to maturity securities was 1.66%. So a 1.66% yield on those $91 billion in bonds. Now here's a chart of yields on the 10-year Treasury. Now the 10-year Treasury is a longer term bond issued by the US government, and it is kind of used as a benchmark for the quote unquote risk-free rate that really drives a lot of the yields that we see in the overall bond market and in the debt markets. Mortgage rates tend to follow this rate pretty closely, and since so much of this this portfolio that Silicon Valley Bank had were in mortgage-backed securities, you could pretty confidently say that the pricing of their bond portfolio probably followed this chart pretty closely. Now, they said their average yield on that portfolio was 1.66%, which would mean they were probably buying a lot in this 2021 period, which is when the 10-year Treasury was hovering around that 1.66% rate. They didn't buy them all at the same time, but they did buy a lot of them in 2021. But now look what's happened to the 10-year Treasury since then. It's all the way up to 3.5%, and it got as high as 4% just in this last month. Now, when their annual report was released on February 24th, the 10-year Treasury rate was 3.94% or so. So it was almost 4%, which is significantly higher than the 1.66% yield that they were showing on their annual report. Now let's do some very quick math just to see what the difference in the market yields would do to the price of their existing bond portfolio, at least approximately. A 1.66% yield on $91 billion or so is a bit over $1.5 billion. Now we can take that $1.5 billion and do some backwards math to figure out what the bond price would be based on the new market yield. Again, on the day of their annual report, the 10-year Treasury was at about a 3.94% yield, and to get the same $1.5 billion in income, that would only require buying $38 billion or so in bonds at that yield. That's less than half of the stated $91 billion that was on the annual report. And just for reference, the day after the FDIC announced that it was taking over Silicon Valley Bank, the 10-year Treasury rate had dropped to about 3.6%, which would imply that the bond portfolio, if it was still the same amount of bonds as before, was only worth about $42 billion. Again, less than half of the value that they stated that they had on December 31st, 2022. And the value probably wasn't much different on December 31st either, because at that point, the 10-year Treasury was at about a 3.88% yield, which would imply about a $39 billion bond portfolio value in market value terms, rather than the stated sort of book value that they were using. So if we go back to their balance sheet, what happens when you erase $40 to $50 billion in held to maturity security value? Well, this number would drop from $91 billion down to 40 or 50 billion, which would mean that their equity would be completely wiped out, because there's only about $16 billion of equity at the stated value of their assets. So now all of a sudden it looks like they're in a far worse position, because if they ever needed to liquidate those bonds to pay back depositors who were asking for their money, they would then have to lock in those losses on the bonds. Now, if you go way down to page 125 of the annual report, Silicon Valley Bank does state that the fair value of their held to maturity securities on December 31st, 2022 was about $76 billion. So even if you take their word for it, that still basically wipes out their equity stated on their balance sheet, and is significantly less than the headline $91 billion number also posted on the balance sheet. The conclusion is the same. They were in a significantly worse position, if not entirely insolvent, when you factored in the held to maturity security losses, even if they weren't as dramatic as my example cases. And this very accounting issue has not gone unnoticed. And as this accounting professor, Kurt Gee, says in this article talking about this accounting rule, says the way we account for held to maturity bonds is based on the original interest rate when the bond was issued, which we call amortized cost on the balance sheet. And because that bond's interest rate is fixed and contractually specified, if the real world's interest rate changes, we ignore those changes in accounting and they are not reflected on the balance sheet. And that's exactly what we saw here. And that's the key takeaway here. If you just looked at the balance sheet and didn't look too much further beyond it, you probably would have thought they were in an okay position, or at least not nearly as bad of a position as they were if you factored in that big market loss that they were facing on a lot of those bonds. But because they designated them as held to maturity and that they weren't intending to sell them, they were able to keep the sort of purchase price value rather than stating the market value of those securities if they were to have to liquidate them in a pinch. And that really wasn't that hard to overlook. And it really goes to show that it's not always as simple as taking a look at the number on the balance sheet and calling it a day. Silicon Valley Bank certainly is not the only company that does its accounting this way. After all, this is allowed under the accounting rules. Maybe that will change in the future, but it's something to watch out for. And there are many different other accounting nuances out there, so tread carefully. And I'd be curious to hear your thoughts in the comments below. And don't forget to subscribe. Thanks for watching.